With 2019 already underway, join us for a review of the factors that will influence the AgChem industry throughout the year. First, let's take a look at the global macroeconomic environment. In 2018, the global economy remained strong, and the global GDP is expected to keep growing at a steady pace in 2019, thanks to a high volume of industrial production and global trade, as well as increased business and consumer confidence. However, this growth rate is lower than previous estimates, and this is mainly a reflection of challenges in emerging markets and instability resulting from trade tensions between the U.S. and China. The strength of the U.S. economy, along with higher interest rates, attracted investments to the country, while substantial tax cuts also boosted growth. Euro area growth slowed down mainly due to a lower export growth, but maintained a relatively strong growth in GDP. However, the attractiveness of the U.S. economy came at the expense of emerging markets. These markets, which already suffer from political risks, low investor confidence, and high debt levels, now also face an outflow of capital to the U.S. As a result, emerging market currencies experienced sharp depreciations in 2018. But the big story of 2018 is undoubtedly the trade dispute, which is evolving between the U.S. and China. Over the past 20 years, the U.S. trade deficit with China has grown enormously. To combat this deficit, the Trump administration adopted a protectionist attitude and imposed tariffs on $250 billion worth of Chinese goods imported into the U.S. China retaliated with its own tariffs on a range of American goods. This clash between the world's two largest economies has caused volatility and a large degree of uncertainty in global markets, having a direct effect on many industries, including agriculture and chemicals. The trade measures have already taken their toll on the Chinese economy, contributing to the slowing down of GDP growth and to the depreciation of the yuan. The trade tension is also increasing volatility in the already unstable Chinese stock markets. As things stand, despite some positive signs, the trade dispute remains unresolved and will continue to impact the global economy in 2019. Let's move on to examine the trends affecting our costs. Oil prices had a roller coaster of a year, increasing to multi-year highs in light of concern of tighter supply and strong demand, before crashing as a result of higher production levels and the U.S. pressure on members of OPEC to keep prices down. Oil prices are expected to make a modest recovery in 2019 as demand remains strong and some production cuts are expected. The global chemical industry experienced slower growth in 2018 due to weaker emerging market demand and the trade dispute. Slow growth rates are also projected for 2019 due to the macroeconomic headwinds and despite the higher prices of Chinese chemicals. Specifically in the agrochemical industry, China's agrochemical prices remained high throughout 2018 as environmental measures intensified. Production was halted in the main AgChem manufacturing regions, resulting in extremely low production volumes. As a consequence, many raw materials, intermediates, and active ingredients are experiencing shortages, and steady supply is not expected in the near future. These higher procurement costs and product shortages will continue to impact our industry in 2019. Shipping rates also rose in 2018, supported mainly by higher oil prices, strong GDP growth, and consolidation in the shipping industry. However, prices declined toward the end of the year as oil prices dropped and U.S.-China trade tensions remained unresolved. In 2019, shipping prices are expected to increase ahead of new sulfur fuel regulations that will come into force in 2020. Having looked at our costs, we can now move on to examine the factors affecting demand for crop protection products. The low crop price environment, which has characterized our industry since 2015, is emerging as the new normal. Global agricultural stocks remain historically high as productivity improvements continue to outpace demand growth. Having said that, as we zoom in to examine the supply-demand balance of each individual crop, some upsides can be expected. For the first time in years, global wheat stocks are expected to decline as strong demand overcomes weaker production. Corn stocks are expected to decline for the second consecutive year as China continues to unload stocks and as global consumption picks up, driven partly by ethanol demand. These dynamics should support moderate corn and wheat price increases in 2019. Cotton prices may also experience some improvement. The outlook for soybean prices depends greatly on the outcome of the U.S.-China trade dispute. Currently, Brazil's soybeans are trading at a premium to U.S. soybeans, but this could change over the coming months. Overall, farmer incomes are still suffering from the low crop price environment. In this environment, yields are the main factor determining farmer margins, and higher yields can help offset the lower prices. The adverse weather experienced this year in key markets such as Europe, Australia, and Argentina significantly impacted yields and crushed farmer margins. While U.S. farmers enjoyed record corn and soybean yields in 2018, their income was hit due to China's retaliatory tariffs, which left U.S. crops without demand. This situation may improve in 2019 as China resumes purchase of U.S. crops, depending on the outcome of the trade dispute. So far, Brazilian farmers are the ones benefiting from the trade dispute, maintaining strong margins set to reach record levels in 2018 and 2019 due to good yields, high demand, and strong prices. How does all this affect inventory in the channel? Low farmer income, coupled with adverse weather events, has negatively impacted channel inventories in key markets. Inventory levels are high in Western and Central Europe, Australia, Argentina, and the U.S. On a positive note, in Brazil, channel inventories continue to ease, although they remain above average. So, how did the industry perform in 2018? Since the decline in value which the market experienced in 2015 and 2016, recovery has been slow. After delivering very minimal growth in 2017, the AgChem industry is estimated to have grown by around 2% in 2018. One of the leading factors to support market growth was the higher procurement cost of agrochemicals from China, which was passed on to customers. Growth was also supported by improved channel inventories in Brazil and high pest pressure in some regions. The depreciation of the U.S. dollar against the euro also had a positive effect on the market in dollar terms. On the negative side, unfavorable weather conditions in key regions and weak farm economies hindered market growth. 2019 is projected to be another year of slow but steady growth. Marginally higher prices of some crops may encourage farmer investment in inputs. Higher agrochemical prices should also support market value. However, low farmer incomes, high inventories which accumulated in some markets, and the likelihood of an El Niño weather event may hold growth back. Nevertheless, we must always be prepared for a black swan, an unexpected event which can disrupt the global market and negatively affect growth prospects. Thank you for watching.